Since the beginning of the year, the market has been on a certain downtrend momentum despite a slight rebound lately. This makes that many companies are now undervalued, and it is why today I'll share with you 3 of the best undervalued companies in which you can invest in right now in May of 2025. So without further ado, let's take a look at the first company on my list. First up is Johnson & Johnson with the ticker G&G. This American pharmaceutical company that is currently worth over $300 billion is one of the few companies that has been able to outperform the market since the beginning of the year despite a slight decrease lately. This more recent decrease has been provoked lately mainly by the rejection of a Texas judge for the company's third attempt to use bankruptcy as a legal shield against lawsuits, which are alleging that its talcum powder products would be causing ovarian cancer. Indeed, at the end of March, a judge has decided that the $10 billion proposal offered by Johnson & Johnson to end tens of thousands of lawsuits was insufficient. This means that in the mid to long term, the amount of money that Johnson & Johnson will need to pay to the victims will be quite higher compared to $10 billion. And so this has been creating a lot of fears for the different shareholders of this business. Nevertheless, at the end of the day, Johnson & Johnson currently have over $40 billion on cash on hands, meaning that they'll be able to use this money to pay back the potential agreement that will be fined in the future. Add to this, Johnson & Johnson through time has been able to establish themselves as the #1 pharmaceutical brand in the world, offering a wide variety of different products to their consumers. For example, essential healthcare products such as Benadryl, Actelion, Benylin, Motrin, Tylenol, Band-Aid, Clean & Clear, Neutrogena, and Nicorette, just to name a few. So it isn't anything new to see this company being able to buy and merge other different big companies in the pharmaceutical fields to add them to their business model. Their latest buyout is the acquisition of the biotech company Intercellular Therapies at the beginning of the year for $14.6 billion. And the least we can say is that this strategy is working pretty well, where we can see that in their latest earnings report, they've been able to outperform the analyst expectations when it comes to both the quarterly revenue and the quarterly earnings per share. Throughout that same event, we've seen that the company has been able to see a slight increase of about 2% in their quarterly sales year over year and an impressive jump of 237% in their net earnings, which was justified by quite lower expenses. So I personally believe that the more recent dip that they've seen in their valuation could represent a great opportunity for people that are looking for an excellent defensive stock with a pretty low beta, and if you're looking to earn great quarterly income from their dividends that is currently of over 3%. Combined to that, at the moment their price to earnings ratio is quite lower compared to what it used to be a few months ago, which would mean that it would be a great entry door for different value investors. Now the second business on my list is the Restaurant Brands International with the ticker QSR. This one is pretty special because it is a fast food holding company. While different fast food companies such as McDonald's, Chipotle, or Domino's all have one ticker, this one has one ticker to hold multiple different fast food brands. It is why by purchasing shares of QSR, you are directly buying certain parts of Burger King, Popeyes, Firehouse Subs, or Tim Hortons. All of this for a holding fast food company that is currently worth about $30 billion, which is about 10 times less compared to a big competitor such as McDonald's. Obviously, McDonald's is still able to generate quite more revenue compared to them, where they've been able to generate over $37 billion in 2024, while the Restaurant Brands International on their side have been able to generate about $8 billion for the same fiscal year. However, when we compare the price to earnings ratio of both companies, we can notice that the QSR one is quite more undervalued. Over the past 3 years, we've also seen that their total revenue have been exploding, which is showing that the fast food industry is quite a recession-proof investment. In fact, fast food operators, even throughout the recession times, have been able to prove that they were able to continuously increase their sales and profit, which makes it one of the most defensive picks for investors seeking safe harbor in this current environment. Add to this, the more recent dip that we've seen in the valuation of this company has been caused by a certain underperformance in their latest earnings report, where where they've missed by 28% the predictions of the analysts when it comes to their quarterly earnings per share. Nevertheless, even if they've missed the analyst expectations, they've still been able to massively increase by over 26% year over year their total revenue, and they've also been able to increase by 14% their total adjusted EBITDA. So it is going to be pretty interesting to see what will be their next earnings reports that are coming up on the 7th of May, so about 2 days from when I am recording this video. And while waiting, make sure to understand that this company, as for Johnson & Johnson, is pretty ideal to have in your portfolio if you are also looking to earn great dividend income with a dividend yield exceeding 3.5%. Finally, the third and last pick on my list is the parent company of Google, which is Alphabet with the ticker GOOGL. By being significantly down year to date, this business might be pretty interesting to you when it comes to their current price to earnings ratio, which actually makes it the most undervalued big tech companies on the market. One of the main reasons that has been causing this downtrend momentum is the growing competition when it comes to the AI field, notably with a program like ChatGPT from OpenAI that can be threatening a certain portion of the total revenue of Google. At the moment, Google owns over 90% of the total search engine market, quite in front of their big competitors such as Yahoo and Baidu, and so it means that Google will be making a certain portion of money from the different advertisements that will be put online. However, as I mentioned, with the coming of new online platforms such as ChatGPT, this could be obviously threatening a certain portion of this total revenue. The good news for Google, however, is the fact that they are also developing their AI program at the moment, which is called Gemini. Additionally, however, Alphabet is currently in the midst of multiple lawsuits that are currently ongoing from the Department of Justice in the United States. And this lawsuit is about a potential illegal monopolization of Google about their browser. Indeed, regulators are saying that Google illegally stiffed competition by paying web browser and phone makers to set Google as their default search engine. But despite these bad news that have been affecting the value of Google lately, we've seen that they've still been able to report some great financial results lately. Indeed, on the 24th of April, Google has been able to both outperform the analyst expectations when it comes to the quarterly earnings per share and their quarterly revenue. During that quarter, their total quarterly revenue actually increased by over 12% year over year, which has helped them to massively increase their net income by over 46%. This incredible increase has been caused by a massive increase in most of their big business segments such as their Google search and other, their YouTube ads, their Google subscriptions, and their Google Cloud revenue that have all been significantly increasing compared to the same period in 2024. For me, it is no surprise knowing the well-diversified business model that Google has with all their different online solutions and programs that have helped them to generate over $350 billion in revenue in 2024. And what makes this business pretty valuable for the investors for the future is the fact that Google is still also massively investing in their technology to stay at the forefront of the competition, notably as I mentioned earlier when it comes to their Gemini AI solution. Add to this, an excellent news of the financial health of this company is that in the latest earnings report, they've been able to increase, more importantly, their total shareholders' equity compared to their total debt, which means that the profitability is increasing and that the company is being in a great financial health at the moment. The great financial health of Google can also be proven by the surge in their free cash flow in the past quarter, as well as the fact that for the first time ever, the management board has been increasing the quarterly dividend that will be now of $0.21 per share per quarter. All of these arguments makes that at the moment, if I had more money to invest in the market right now in different individual companies, I would definitely be considering investing a portion of it directly into Google. But now that you've just discovered 3 of the best companies in which you can invest in right now in the month of May of 2025, you might want to find a more defensive and better approach for the long term, which would be to invest in great ETFs for the rest of 2025. And so in that case, make sure to check out the video that's gonna be right over here, and I will see you soon. Peace.